Hello everyone, so this is the third video in our mutual fund series. If you haven't watched the previous video, please check out the links below. So the name is Sajan and welcome to Financepedia. So today we are going to dive into the crucial topic of 10 steps of selecting the right mutual funds for your investments. Let's get started. With thousands of mutual funds available, choosing the best one can be the difficult task. In mutual fund applications, we have seen plenty of categories and subcategories of mutual funds like equity, debt, index, and solution oriented funds, NFOs, and so on. The first step is profiling. This lies with you, the investor. You are the designer of your portfolio and the decision maker. Your investment choices depend upon your risk tolerance and financial goals. Let's say you are an aggressive investor. Then you have to choose equity mutual funds. If you are a conservative investor, then you have to choose debt mutual funds. And if you are a moderate investor, then you have to choose hybrid mutual funds. These are a combination of equity and debt mutual funds. Okay. Now, the second step. This step is called purpose. At this point, you should consider the investment tenor. That how long can you keep your money invested? And the investment amount, that how much can you afford to invest. These are personal preference that vary from person to person. By understanding your own needs and risk tolerance, you can make informed decisions when selecting a mutual fund. Now, step 3, getting deeper into fundamental and technical analysis. Once you have determined your investment goals and risk tolerance, it's essential to evaluate the fundamentals and technical aspects of mutual funds. Now, about AMC, Asset Management Company. Research the asset management company who's managing the mutual fund. Every mutual fund has an AMC who's responsible for fund management. Look for their proven track record of the fund house and the experience and credentials of the fund manager. Also look into their AMC's philosophy, strategy, and the NAV, net asset value. Compare the NAV value of similar category mutual funds. For example, you might be seeing a large cap fund with 50 NAV and another large cap fund with 100 NAV. So understand the reasons behind the difference in NAV values, including fund performance, investment strategy, expense ratio, dividend payout history. By analyzing these factors, you will be equipped to make informed investment decisions and choose the right mutual fund for your portfolio. Now, the fourth step, vintage of the fund. Generally, the older the fund, the better it tends to perform. A higher vintage fund can be a good sign of a mutual fund's stability, credibility, and ability to navigate various market conditions. Now, the fifth step, analyzing assets under management, AUM. When evaluating a mutual fund, it's essential to analyze the AUM managed by the fund house. A higher AUM generally indicates greater diversification, lower risk, and increased stability. Now, the sixth step, reviewing historical data. Examining a fund's historical performance helps you understand its track record during bear and bull market, risk and reward profile. This will help us know the ability to navigate challenging market conditions. By analyzing historical data, you can make more informed investment decisions and better management of your expectations. Now, the seventh step, standard deviation in mutual fund. This is a statistical measurement that helps to assess the risk or volatility of a mutual fund. It calculates how much the fund's returns deviate from its average return over a specific period. A higher standard deviation indicates a higher volatility, higher risk, and also higher potential for higher returns during favorable market conditions. A lower standard deviation indicates a lower volatility, a lower risk. Therefore, the fund's returns are more consistent and predictable. Now, the eighth step, it's the measurement of Sharpe ratio. A Sharpe ratio is a statistical measure that helps investor understand the relationship between a mutual fund's returns and its risk. In simple sentence, let's say a FD gives you 7% returns and the mutual fund gives you 10% returns, and the ratio of these two is called Sharpe ratio. A higher Sharpe ratio indicates higher returns and has managed risk effectively by minimizing the losses during the market downturns. Now, the ninth step, the expense ratio. As I mentioned earlier, the expense ratio is a crucial factor to consider when selecting a mutual fund. In simple terms, the expense ratio is the fee charged by the fund house for managing the mutual fund. This fee is deducted from the invested mutual fund. For example, if you invest 100 rupees in a mutual fund with an expense ratio of 1%, only 99% will be invested. You will earn the returns on the invested amount of 99 only. So, a smaller expense ratio is generally better, as it means you will pay less in fees and potentially earn higher returns when comparing mutual funds. Look for those lower expense ratio to maximize your investment. Now, the final step, the 10th step, performance analysis. The final step in selecting a mutual fund involves analyzing its performance. This includes calendar returns. Calendar returns is a measurement of mutual funds performance over a specific calendar year. For example, January 1 to December 31st. It provides a snapshot of the fund's performance during a particular year. Then comes trailing returns. Trailing returns is a measurement of mutual funds performance over a specific period, for example, 1 year, 3 year, 5 year. Trailing returns used for a quick snapshot of funds' recent performance or to compare funds with similar investment objectives. Then comes rolling returns. This is the evaluation of funds' performance to assess consistency and volatility to identify patterns in a fund's returns. Rolling returns measure a mutual fund's performance over a specific period. Example, same like the trailing returns 1 year, 3 year and 5 year. Okay. So when evaluating performance, consider your investment horizon. For short-term needs, hybrid or debt funds might be more suitable than direct equity mutual funds. So be wise while selecting the mutual fund. And last but not the least, the taxation part. All the profits we take has taxation, and in the next video I will let you know what all are the taxes and how to pay all these taxes and what all are the new ways to save taxes. I will tell you in the next video. And if you have any doubts regarding the selection of mutual fund, please comment your thoughts and let me know, and I will respond to help you for sure. So stay connected to Financepedia and subscribe and click the bell icon to get notified about the next video. Thanks for watching Financepedia, the Learn and Earn Media.